Hi everyone and welcome to our second quarterly call of 2018. We have muted all of the phone lines. This call is being recorded and will be available for replay by visiting www.o'keefestevens.com and clicking on the resource tab and then selecting the value conversation link. Before we get started, we must remind you that the purpose of today's call is educational and the material presented is publicly available information from sources believed to be reliable. The information in this material may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. This call will be available for replay on the O'Keefe Stevens Advisory website located under the Resource tab. Please contact us if you would like a link to the recording of this call or any previous calls.
Thanks, Carly, and thank you for joining us on the call today. For those of you who have had a meeting with us recently, our market commentary section on today's call might seem a little redundant from our meeting discussions. We've been talking about how certain sectors and companies that we believe are overvalued have become overweighted in the indexes. So we're going to compare our holdings to the index and then compare them specifically to some of the current market favorites. And what we find in doing that is that our way of thinking is very different than the overall market consensus. And this contrarian approach has always worked well for us. However, it means our portfolio often behaves differently than the overall market. And so on today's call, we're going to explain what's different and why we're confident in our decision to be different. So the format for today's call will be similar to our previous calls. I have some market perspectives to share, and I'll relate those ideas to a portion of our investment process. We've shared the optimal buy zone graphic on previous calls, and I think it's worth sharing again to add perspective on the purchases we're making. Peter is going to share insights on 3 investments we made during the recent quarter, and we'll relate those purchases to our market commentary and investment process idea. So those 3 companies for today's call are Seritage, Amgen, and Discovery Communications. We've been active this quarter in visiting the companies that we own, and we want to spend a minute or two updating you on our visits to annual shareholder meetings. And finally, we did receive a couple of questions for today's call that we'll address at the end of the call. As a reminder, if you send us questions prior to the call, we'll be sure to feature them in the question and answer section. So to begin our commentary on the overall market, I think it'd be helpful to look at the breakdown of the different sectors and their performance in the S&P and compare those to the portfolio here at O'Keefe Stevens Advisory. So the chart on the screen details 10 sectors of the S&P 500 index and compares the weighting of those sectors as a percentage to the weighting of our holdings at our firm. Additionally, I've included the year-to-date return for each sector just for some perspective. So a couple of things to point out. You'll notice that most of the sectors in the S&P have had negative performance for the year, and actually it's only 3 sectors that have performed positively during the year: consumer discretionary, technology, and energy, which has recovered with rising fuel prices. But between those 3 categories, we already have nearly half the index weighting of the S&P 500. So we made the decision to look different from the overall index in a number of ways. First of all, we're far more concentrated and focused in the positions we own. Over time, we believe that this style of focused investing lends itself to better long-term decision-making because we're intimately familiar with the companies we own. Second, we intentionally overweighted or underweighted specific sectors based on where we find values in the market. The first and most clear example of this is in real estate. The real estate companies, namely REITs, represent 2.7% of the S&P 500 index. Now, up until a couple of years ago, real estate did not even have its own sector in the S&P index. But we view real estate as an important equity component for most portfolios. The real estate market behaves differently, and it's often not correlated to the overall market. In our current circumstances, we've found many dislocations between price and value in real estate. And while these investments are currently depressed in their price, we see many reasons to hold those companies, collect their dividends, and wait for markets to rationalize. You'll also notice we are underweight in the two best performing sectors in the S&P, consumer discretionary and technology. And those sectors tend to be where growth stocks dominate and value opportunities are scarce. There are instances where the overall markets drop in price and these sectors can be purchased at discount or reasonable prices, but that is not how we would describe today's environment. I have some more information to share on tech stocks on the next slide, but the takeaway here is to notice that we are substantially underweight in these two sectors. And for our newer investors who are not invested when we made our purchases in NVIDIA, the technology sector is an even lower weighting in the portfolio. And then finally, cash reserves or money market funds make our portfolio look very different than the index, which holds no cash. This element of our portfolio weighting exists for a number of reasons. First and foremost, the assets we manage typically provide our clients with a retirement income, and therefore a certain percentage of the funds need to be kept in liquid, non-fluctuating assets to meet withdrawal needs. Second, many of our investors do not contribute to their accounts on a regular basis, and therefore we keep a reserve available to make purchases when opportunities arise. You've probably noticed our recent purchases at the end of the quarter, and this is a perfect example of why we want to have reserves available at all times to make these timely purchases. We're believers in the concept that in order to outperform, you need to do something different than everyone else. We're also realistic in understanding that performance is a metric that's best measured over years, not months. So while we've lagged in performance over the last year, we're not discouraged by those results. We understand the opportunities in the positions we own. We have confidence in the management of those companies, and we've steered clear of investments in overpriced companies. So we're acting conservative, we're thinking with a long-term orientation, and we're continuing to invest when we identify businesses that meet our standards. It takes time to unfold, and we're okay with that. The style is what works for us, and it allows us to sleep well at night. So this slide was actually a last-minute addition, but I think it's an interesting aside that ties into my next comments about Amazon. An interesting point about technology that most people are probably not aware of is that since December 2013, or the last 4.5 years or so, 7 tech stocks, Amazon, NVIDIA, Apple, Microsoft, Facebook, Google or Alphabet, and Netflix, they have combined returns that represent more than half of the S&P 500 increases. And that's really staggering and puts into what's happening right now into perspective. We have certain sectors and certain companies in the market that are not overvalued, while others are becoming dangerously overpriced in our opinion. So let's talk about one of those 7 stocks as an example. The lesson from the investment process that we wanted to share with you today is valuation is important. And rather than talk about the ins and outs for valuing a business and comparing that to historic values and other companies in the market, I think it makes the most sense to just use a real-life example. Peter and I attended the Guru Focus Conference in Omaha, Nebraska while we were in town for the Berkshire shareholders meeting this May. And we had the opportunity to listen to many excellent presenters, and we actually borrowed this information from Bill Smead, who runs a fund based out of Seattle, Washington. Bill's team dissected Amazon as a business and an investment in order to compare its value to some other companies we could own instead. So as you can see on the slide, there's no denying the success of Amazon over the last year. The company is now worth $750 billion, employs over 500,000 people, and investors seem motivated by everything that they're doing because even at $1,500 a share, the price keeps surging ahead. In fact, tying this idea into the last slide, Amazon's price appreciation has been responsible for over 1/3 of the S&P's return year to date. And in our opinion, the company's great, but the stock has just gotten way ahead of itself. Let's take a look at some other businesses we could own instead of owning Amazon if we were interested in buying the whole company with that $750 billion in valuation. On this list, we could purchase Target, Nordstrom, Amgen, Discovery Communications, AmerisourceBergen, eBay, Tegna, Disney, Walgreens, Comcast, Kroger, and American Express, and we'd still have $27 billion in cash left over, which doesn't hurt. So the price we would pay to own all these businesses is less than the price we pay to own all of Amazon. And the question is, well, which would you rather own? Our answer is to own the cheaper and more diverse bunch, if you couldn't guess, but it's not just about being attracted to low price either. So if we look at even more details of what's going on between Amazon and the comparison group, I think you're going to be astonished to see how vastly more productive our diverse group of businesses is than the crowd-favored Amazon. So total sales of the comparison group are nearly 4 times that of Amazon, and net income or profits are over 20 times Amazon's. So how could that happen? Well, if you look down near the bottom of the list, you find our answer. Amazon's Jeff Bezos has publicly stated, "Your margins are our opportunity," which is a great soundbite and exciting for prospects of a company that's changing the landscape for the way consumers shop. However, this approach doesn't exactly work from a traditional business sense. Amazon's margins are a paltry 1.3% compared to 11.3% of our comparison group, and that produces a situation where their actual returns on equity invested in the business are far less than the typical businesses that we like to own. On a per-share basis, we see this problem materialize in the exorbitant price-to-earnings ratio of Amazon against the comparison group. Amazon trades at exceedingly high prices relative to other companies, and evidently investors are confident in the growth and the continued growth of the company and the changing landscape of consumer behavior. And however true that change in consumer behavior will be, we're concerned that the price has gotten far ahead of the economic reality, and we realize this dynamic often leaves investors with far less to show for their ownership at future dates. In fact, the situation is eerily similar to Cisco Systems in the year 2000. But looking back on that situation, Cisco had swelled to a $500 billion company in the year 2000. And it was the crowd favorite of the year. You could have, instead of buying Cisco, bought a diverse basket of several great companies in lieu of Cisco at that same time and still had money to spare, just like the last example with Amazon. And we've kept this sheet that was published over 10 years ago as an example of what overpaying for an investment can do to a stockholder. So over the past 18 years, Cisco has in fact grown its revenues and profits, yet because investors overpaid for the stock, the holder of Cisco from 2000 to 2018 has seen the value of their investment drop by over 60%. Today, the basket of comparable stocks is worth $2.3 trillion. It's actually higher than that. And Cisco is worth about $206 billion today. And the lesson to be learned here is price is what you pay, value is what you get. It's best to buy companies at good values and avoid those that are overpriced relative to what they produce. We've used this chart on previous calls to visualize this concept. We're looking to buy high-quality companies when they trade on the lower side of the price curve represented on this chart. Amazon is literally off this chart, in our opinion, and while it's a high-quality company, its public market valuation is stratospheric and therefore out of the realm of competency from a valuation standpoint. We're far more interested in the businesses that may be temporarily depressed in price, but still maintain the attributes of being high quality and well managed. And this idea ties in nicely to our recent purchases in Seritage, Amgen, and Discovery Communications. And so with that, I'm going to pass it off to Peter, who will take us through an example of those companies. Peter?
Thanks, Justin. Going back to Justin's comments on the different sectors in the Standard & Poor's 500 index, so far, real estate has been one of the poorest performing market sectors during the past year. However, we see long-term opportunity rather than short-term underperformance. On Tuesday, April 24th, Justin and I traveled to New York City. I attended the annual meeting of Seritage, and Justin attended the Kimco Realty meeting, as they were both held at 10 a.m. Our visits confirmed our research. With Seritage and Kimco, we have some of the best values in real estate. Seritage Growth Properties is a U.S.-based real estate investment trust that was spun out of Sears Holdings in 2015. During the quarter, we took advantage of the recent price declines by adding to our position. Seritage declined from its high valuation in April of 2016 of over $57 per share to around $35 per share. This lower price approaches the price levels of the spin-off valuation in 2015. To refresh your memory, Seritage owns 249 properties, totaling nearly 39 million square feet on 3,000 acres across 49 states. As a standalone company, Seritage is repurposing the legacy Sears and Kmart properties to higher and better use. During the past 3 years, CEO Benjamin Schall and his experienced real estate redevelopment team have performed well, creating significant shareholder value through the redevelopment of their prime location real estate portfolio. Let me update you on some of the metrics of the redevelopment. So far, 83 projects have been commenced or completed at a total cost of $1.3 billion. Over 500 million square feet of new leases have been signed with rents of approximately $18 per square foot, or over 4 times the rent that was paid by Sears. And finally, the number of properties without Sears as the primary tenant has increased from 11 at inception in July of 2015 to 126 currently. We are investing in Seritage with a number of other value investors, such as Warren Buffett, who owns 5.7% of the outstanding common stock. We are delighted to own Seritage, and we believe we will see a substantial creation of value as they continue to put the assets to more productive use. During the quarter, we also added to our position in Amgen. Our original investment was established in 1997, and we've added to it a number of times since. Amgen was founded in 1980 and is the world's largest independent biotechnology company. Amgen has a history of blockbuster products. Among these are Epigen and Aricept, which is primarily for anemia patients to increase their red blood cell counts. They also have Neupogen and Neulasta, which perform a similar function for increasing white blood cells, and Enprel, another success used in treating arthritis. Due to patent expirations and the creation of biosimilar products, Amgen is facing competitive pressures that have resulted in Amgen's stock price trading at the lower end of its 52-week high-low range, thereby creating what we believe is an attractive entry price. Amgen has been firmly committed to research and development and has a diversified product portfolio across 6 therapeutic areas. Among the newer products that offer blockbuster potential are Repatha for high cholesterol and Aimovig for migraine headaches. Amgen is very profitable and has enormous free cash flows. In 2017, Amgen generated over $10 billion in free cash flows. As we have explained in our writings on these calls in the past, how a company uses its cash is critical to its long-term performance, and Amgen has been an excellent allocator of cash. For example, on their share repurchases, that's one way in which a company can allocate some of its free cash flow. Since 2002, Amgen has reduced its outstanding shares by over 40%. Most recently, a $10 billion share repurchase was completed during the first quarter of this year. We believe that this continued shrinkage of its outstanding shares will ultimately be reflected in a higher share price of the common. Another allocation of free cash flow is the payment of dividends. Amgen began paying a cash dividend in 2011, and since that time, the payment has grown substantially on an annual basis. Now, dividends can make up a substantial portion of an investment's return, and it's particularly important for investors who need to grow their incomes to fund their retirement needs. The key to a successful healthcare, or any business for that matter, is research and development. In 2017, Amgen invested over $3.5 billion in research and development, which is equivalent to 15% of the company's revenues. The investment seeds the future of the company and allows the business to develop new life-changing treatments. We believe that the new products and the continued developing pipeline of products will position Amgen for continued growth. The management stewardship aligns with our priorities, and we were able to purchase this great company during a temporary setback in share price. In this instance, we paid a reasonable price for a steadily growing business that produces sizable free cash flows. We expect to see improvement in new products. We expect to see improvement as new products are brought to market, and expect to own the shares for a long time while we enjoy the returns generated from dividends, share repurchases, and price appreciation. And finally, we want to discuss Discovery Communications, a sector Justin discussed in the earlier slides and mentioned our underweighting position is the consumer discretionary sector. Our reason for underweighting this sector is price. We've simply been unable to find mispriced and undervalued securities in recent years. An extreme example in today's market is Netflix. The stock has gone from $10 in 2012 to $365 at yesterday's close. However, as value investors, this investment makes little economic sense to us. With operating cash flows in 2017 of a negative $1.85 billion, debt of $6.5 billion, and a price-to-earnings ratio of 240 times, we simply would not touch it. But recently, we did find a consumer discretionary investment meeting our needs as value investors in Discovery Communications. Discovery is a global media company with presence in 220 countries. In March, Discovery and Scripps Networks merged to form a company with similar revenues to Netflix, yet it sells at 1/10 the price. As value investors, we find a lot to like here. The price-to-earnings ratio is about 10. Net operating cash flows of $1.7 billion compared to the negative $1.85 billion of Netflix. They have a large portfolio of content, including many familiar names such as the Discovery Channel, HGTV, the Food Network, TLC, and dozens of others. Discovery common stock trades at less than 50% of its 2013 high. And naturally, there are some issues with this investment, especially when you consider that to find an undervalued investment, there has to be some issues with the company. We believe that the discount in Discovery exists due to the transformation of the media industry that they're undergoing at the moment and the decreasing number of traditional cable subscribers. In addition, Discovery has more debt than many investors, including ourselves, would like to see. However, we have read and digested numerous research reports and believe we have a management team with a plan to reduce debt, to grow the business while using its substantial cash flows that it's generated from advertising and its content. At these prices, we view Discovery Communications as an excellent long-term investment. The company is trading in our buy zone and is unloved by others. We will be patient and wait for the markets to realize what we have with Discovery. Justin?
Thanks, Pete. And finally, we just wanted to bring you up to speed with our company visits for the quarter. I mentioned already that Peter and I were in New York at the end of April. We had the opportunity to speak with other institutional shareholders and the management at the Kimco and Seritage presentations. And both those visits increased our comfort in the investments we've made. They opened up lines of communication with those companies to ask specific questions about their strategy and the specific real estate holdings. We also visited Berkshire Hathaway in Omaha, Nebraska. The Berkshire meeting is one of our all-time favorites to attend. It's always full of sound advice. Both Warren Buffett and Charlie Munger continue to offer valuable perspective, and we keep learning from them. while we were in Omaha, we attended the Guru Focus Conference. That's an investor conference we paid to attend and hear from some outstanding investment professionals. It was helpful for our own idea generation process and tuned us into some elements that other investment analysts in their processes, and that proved to be very helpful as well. And then we both attended the Manual of Ideas Global Networking event and heard investment pitches from 10 other investment managers. Those investments, while they weren't of immediate interest to us, I'd say it was incredibly helpful to listen to how other investors approached the analysis process. We connected with several people during our 5 days in Omaha, and we came back to Rochester with a lot of reading and research work. The one that's not listed on here wasn't an actual meeting that we flew out to attend, but Peter and I both attended the NVIDIA annual shareholders meeting, which is a conference that's held virtually that you tune into on the computer, and we were, as always, motivated by the news that we learned about NVIDIA. So if you have any questions about these visits or any of the companies that we own, we take notes when we go to these meetings, and we're happy to share our thoughts with you. Carly?
Okay, thank you again for joining us on this call. We've received some pre-submitted questions, and we'll now go through them with the answers. We have received a few questions from clients regarding specific investments that we have owned for a number of years. These holdings do not apply to all of our clients, but we will provide an update for those of you who find this information relevant. The first question comes from Bill C., and it is referencing a holding that closed in 2015, the Third Avenue Focus Credit Fund. There was a class action suit filed against Third Ave in 2017, and our firm supplied paperwork to any clients who had exposure to this holding in their accounts. We completed a detailed list of any buys and sells made during the ownership period affected in the class action suit and sent in paperwork on your behalf. To date, there hasn't been a response from Third Ave. Do we have any updates?
Well, thanks for the question, Bill, and probably as a reminder to everybody who did fill out that paperwork that we sent out, because it's been almost a year. We did hear something today. So if you did receive a statement in the mail, if you didn't receive a statement in the mail, they have received your paperwork. There was an instance where somebody did not complete it, and we received paperwork back just this week that the process wasn't completed and they needed to reply. So certainly if you have received anything in the last week, please forward that on to our office so that we can take the appropriate action. The settlement for the class action suit is still pending. Peter contacted Third Ave in an email, and they forwarded his question to Ghilardi & Company, the law firm representing shareholders in the suit. Their response stated that all forms that were postmarked before July 19th, 2017, which was the deadline, that they're being processed, and the average processing time is 6 to 9 months. Once that processing is complete by the attorney's office, the counsel and the court must authorize distribution of the funds, which can also take several months. So if additional information is needed for processing, the time frame might not be accurate and could involve additional steps. So again, if you receive anything in the mail, please forward it to us in a timely manner, as there are some tight deadlines associated with that. What I have to say here is we know this answer is not specific and not instructional, but we basically understand that the typical processing time can be over a year with these types of situations. We're approaching the 1-year mark since the documents were collected, and we're hoping to see receipt of the funds from the settlement by the end of the year, but again, that's not guaranteed. Carly?
Okay. Our next question comes from Steve D., and is regarding Patterson Companies. Patterson is down about 50% since our initial purchase. What is the plan for this holding?
Again, thanks for the question, Steve. Our plan is to continue to hang on to our Patterson, and we're investigating the situation further. The reason for the decline in price is due to some scrutiny by the Federal Trade Commission, and is based on allegations that federal antitrust laws, which protect many industries, but in specific here, the dental products industry, that there was violations there. So the three companies involved in the allegation are our shares in Patterson, Henry Schein, and Benco Dental. Those three companies collectively control 85% of the U.S. dental supply market. All three are denying the charges, but the trial doesn't begin until October of this year. And so there's definitely some uncertainty in the meantime. Additionally, Patterson delivered earnings that were below analyst estimates in the third fiscal quarter. And we've owned this stock in the past, and we've seen that analyst downgrades send the share prices down immensely. And if we wait and see we've seen the shares recover upon future earnings estimates being met or beat in the past. So like I said, there's definitely some degree of uncertainty with Patterson. We continue to keep our eye on the increasing dividends and the share repurchase program, both of which are performing positively. We want to avoid the mistake of selling at an inopportune time. And until we have more information, we're content with waiting. We'll keep you updated. Carly?
Okay, and that ends our question and answer session for today. As a reminder, for future calls, you can send in your questions in advance of the call to any member of our team. We look forward to addressing your future investment questions on these calls, and thank you for tuning in to our commentary on the market and your investments. Thank you again for your time today, and this call will be available for replay within 24 hours on our website.